Already, guys, I am back with a live because I want to go live. Sorry, you guys. Just playing. Hold on. Let me look at my real quick. Yes, I saw it just now. Where did it go? Where did it go? Right here. All right. Live because. Okay, let me move this up here real quick. Alright, so we are live. So why am I live with you guys right now? Well, because I can, you know. I just got done eating, and this is another episode of GameStop versus other company, right? Now this one kind of come about because I was watching this segment just randomly, right? Because I was watching CNBC before, and I was curious. Okay, who are these analysts, right? So let's just listen in, and then I'll tell you what's going on later on, okay? While we're waiting for people to join in, so let's enjoy this together.
Bank of America CEO Brian Moynihan on Squawk on the Street earlier today saying he sees a slowdown in consumer activity despite the stronger than expected retail sales report this morning. Joining me here to discuss is Greg Mellick of Evercore ISI. Greg, it's good to have you here. It's maybe some mixed signals coming out. The unequivocally strong number from the government retail sales report today, also some upward revisions from the prior month. On the other hand, some of the card tracking data maybe is more ambiguous, and universally expectations that the consumer is going to show some fatigue before too long. Where do you come down?
We're in the slow drip deceleration is here. It's frankly been happening all year. But it's not collapsing. And as long as we get good jobs growth, we don't think U.S. retail sales are going to go nominally negative, which I think is what the bears are really ultimately thinking.
Right. So nominally, certainly still pretty strong. And of course, it's feeding into some of the GDP models for the third quarter, close to 5% annualized growth. So clearly seems pretty robust. I guess just not even across the retail space. And to me, the big question is, look, if you see weakness in certain segments, has the market already figured that out, right? You punish the dollar stores. Electronics has not been a hot spot within retail. So where is there opportunity between what the market is priced in and where the consumer is still strong?
It's a great question. I think if you look at it from a category standpoint, you can see it all year and just continuing. The big ticket discretionary categories, things like electronics and appliances, home improvement, home furnishings, department stores, all those categories are down nominally year over year. So all the growth is coming from restaurants, drugstores, some unique areas like auto parts where people can't afford new cars, so they're fixing up their old ones. So there are a few categories that are driving all of the growth. And a lot of the bigger ticket discretionary ones are down. In terms of picking retailers and stocks, we think this decelerating environment is perfect for retailers that are gaining share. And we love to look at traffic as part of that. It can't just be by taking price. In fact, it really shouldn't be by taking price. It should be by winning more customers than you had. And if we look at our top names, our top 5 portfolio is Costco, Walmart, Kroger, and then we look for O'Reilly Automotive and Sherwin-Williams to round out the top 5. And so to me, those are companies that are winning share, and they're doing it in a way that they can therefore be more profitable and come out of this stronger.
Yeah, and certainly seems as if, it tilts based on your process toward net defensive things like Costco and Walmart. On the other hand, interested in Sherwin-Williams. I mean, is that simply because, stock's down enough? Is it a call on housing activity or something else?
Yeah, no, Sherwin has been our favorite in the whole home improvement space. So the 3 names we do recommend there are Sherwin, Home Depot, and Tractor Supply. But Sherwin is the one that we think has a nice margin story this year, that they finally have raw material costs coming down, and the pricing from the prior few years is flowing through to help good gross margin expansion. The other thing is the category tends to be a little bit more defensive than a lot of other areas of home improvement, so that it's a little less cyclical. So I would say that's why Sherwin is the horse we're riding in that area. O'Reilly is another one that you point out. Yes, it's technically consumer discretionary, but in reality, it acts more like a staple. If you got to keep the cars in the vehicle fleet running and we can't afford the new cars, to us, that's still the share gainer and the winner in the space.
All right, so reason I show you that video was because I was curious. Okay, if I were to look into, you know, the share price of this company, and I wonder what their stat looks like, right? So let me hold on before I okay, reconnect successful. Okay, sorry about that. Hopefully it comes back. All right, sorry, just keep disconnecting me for so disconnecting and redisconnecting, so I'm sorry about that. But anyway, it seems like it's coming back. So as I was saying, you know, Kroger, I took a look before, but not recently. This is the company that I looked kind of recently, so I kind of know what's going on here, and that's what I want to kind of focus on. Costco, of course, we know that it's a good company already. Sherwin-Williams, never take a look at them. Apparently, they are the, you know, home builder. I don't know. We'll take a look at that company, and Walmart. So I'm not gonna take a look at Walmart because I don't know if I'm gonna like it, but hey, if we have time, we'll go through them. So let's go through Kroger real quick, right? So my suspicion is that, like, every time they tell you to buy certain things, I'm like skeptical, right? It's like, I wonder if I take a look at the balance sheet, what's going on there, right? So why are they pushing this company in front of your face? So let's go look at it. Of course, the market cap is $32 billion. The revenue, wow, how come it's so high? 148, is that right? Is that, or a typo? Could be a typo there. Net income is 1.6 right there. That's not too shabby. At least it's you know, in the positive. And of course, the price targets right here is 17% up from here, right? If you look at the forecast, obviously they want you to buy into it. I guess it's hold as well if you want to hold on to this. The low is this, average is 52, high is 60. Okay, that sure makes sense. Who are these analysts? HSBC, not quite sure who these people are. So hey, it's all buy, right? Okay, well, let's take a look at the stat. Continue to take a look at the stat. Of course, they do some dividend payout right here. Payout 51% at the time. So I guess that's probably the enticing factor here, is that you get payout dividends. As far as like ownership, you see, insider ownership is almost always this low, right? Now they might have different excuse as to why that is. Maybe it's the most valuable stock. They rather own other company other than themselves. I don't know. Again, anytime I see this coming, I feel like I wouldn't want to own that stock, right? Again, it's just me. Was the float is around two times GameStop's float. And you know, before I go any further, obviously I'm not a financial advisor. You know, I get my education through Googling things. So please, you know, if you want a special advice or a professional advice, consult professional analysts. Okay, again, I'm not the person for it. Just trying to share the journey with you here, right? Okay, with that all out of the way. So as you can see right here, revenue is so high. I don't understand why it's so high. But look at the net income. It's only 1% of the net income. So it might have been a whole bunch of expenses that they have to pay out. We'll see in detail later on. If you look at price to sell, that's pretty good, less than 1. We want less than 10 here. So that's good. Apparently, PEG ratio, anything below 3, between 2 and 3 is good, but below 1 is excellent. Let's see, price to book 3 times. Price over shareholder equity. That's not too bad, right? Okay, and then cash equivalents. Okay, cash on hand to 2.4 billion right there. And of course, if you look at this, debt to shareholder equity 2 to 1. We want it less than 1 if this ratio is good. So more than 1 is bad. Quick ratio, look at this. They need cash fast, right? Meaning that they have less cash than the current liability. So eventually they're gonna go to shareholder equity, right? And I bet you anything, every single stock that these talking heads, right, want you to buy or suggest to you in front of you has a quick ratio of less than 1. Keep in mind, GameStop has more than 1 quick ratio. Okay, so before they go to shareholder, they would, have enough cash on hand to operate the day-to-day. Okay, if you read the definition right there, a low number indicates that the company may have trouble paying its upcoming financial obligation. Okay, so yeah. And the current ratio, obviously, current asset is lower than current liability. That's why you see 0.7 right there. Okay. If you look at the capital expenditure, it's $3.4 billion right there. That's high, but compared to the operating cash flow, that's not too bad. If you do the free cash flow, of course, it's free cash flow positive. That's good, right? Not knocking that. And of course, return on equity, 15%. So technically, you could still make money on that because of the profit margin. Of course, the gross profit margin is kind of low for this Kroger. And that's why, compared to the revenue versus profit or net income, it's so low, like down to 1% here. So is it a good buy? I don't know. Again, this is just me sharing my journey with you. But to me, I feel a bit uneased when you see stuff like this, right? See, look at working capital. You want working capital to be positive. So what is working capital? If you look at is the amount of money available to business to conduct its day-to-day operation. It calculates by subtracting total current liability from the total current assets. So if you have more liability, okay, than asset, you are going to have negative working capital. Working capital for GameStop is close to $1 billion if you look at it. Now again, these two companies are different company. I get that, but come on, like in relative term, you want to see these good things. And look at this, net cash, negative $17 billion. Of course they want you to buy this company, right? Man, but yeah, so far, no, I'm not gonna buy it. Of course, right? Again, allegedly. I'm not a financial advice, but I'm telling you what I'm doing here. So if you look at the trailing 12, I've loved to look at this. Of course, you see that there's increase in revenue, 2% here. But I feel like most of this is probably due to inflation. It has nothing to do with the actual growth of the company. So as we all know, inflation is going amok. Obviously, it's not 2%. I bet you anything it's more than 4 or 5%, right? Again, like they have the financial incentive to tell you otherwise, okay? Okay, so if you look at the gross income, obviously it's $32 billion right here. Operating income, $2 billion. Pre-tax income, net, they net very low compared to the actual revenue. As far as share dilution, it looks like they kind of take some of the share out of the market, so that's good for shareholder. But I'm trying to look for, and then dividend per stock, obviously they pay some out there. That's gonna cut into their bottom line. Day to day, obviously the margin is a positive 1.8%. I mean, it's razor thin. Okay, it's a very thin margin type of business here. Okay, so it looks like they have $2.4 billion right there. Asset versus liability. If you look at the shareholder equity, I guess they have some good shareholder equity. The only thing I'm worried about is the fact that they don't have enough cash. You look at the cash and all that, and then current liability right here. See that? Current liability, 1.3 there. Other current liability, total current liability. So if you were to do that math, if you were to subtract the total amount of cash and cash equivalent and subtract the total amount of debt, you have negative net cash. So that's bad, right? You want it to be positive, because if you get liquidated, you're not going to dip into the shareholder equity, right? So yeah, what gives? And look at the working capital. Obviously, they don't have a positive working capital, but at the very least, who are they going to go first? I bet you anything they're going to try to drain this right here, shareholder equity, right? And of course, they have a massive amount of debt right here, $20 billion. It seems like they did pay down a little bit here, 2%, but that's not by much. Yeah, returning earnings pretty good. I bet you anything that's probably a like membership or something. Yeah, it's not a very good balance sheet here. Now, I'm not saying they're gonna go bankrupt anytime soon, but they're gonna dip into shareholder equity. I bet you anything. And it looks like they lose investing cash flow. They somehow either the commercial aspect of it, the building, or whatever they're doing with the investing cash flow, they lost $3 billion right there. Finance cash flow, they lost that much right there. But net cash flow is pretty good. I guess $1.3 billion. That's pretty good. So dividend pay, of course, they spend close to $1 billion, $750 million to shareholder in stock. I mean, in dividends. At the very least, they're positive cash flow, sure. And stock-based compensation, there you go. It's around $179 million in the last 12 months being given to the executive. So all in all, I mean, how would I rate this, right? I mean, to me, if I look into this and I see the fact that their quick ratio is lower than 1, but they've been lower than 1 a long time. So since 2020, 22, 23. So that's not like the immediate concern or anything. So I bet they were able to service that quick ratio of around the same thing. I mean, sorry, current ratio and quick ratio, if you look at the history of it, you know, it's actually been up. So not immediate, you know, don't buy this and all that stuff. But if you look at the insider ownership, that's what the deterrent for me is, the insider ownership and the fact that they have negative working capital right now, close to $3 billion. I mean, $3.69 billion. That's pretty large. And then if you look at the debt to equity too, that's a concern as far as servicing their debt. It's not, you know, it's not the end of the world. But anyway, so this is Kroger, right? So let's take a look at other one. This one right here, Sherwin-Williams. So I haven't taken a look at this one yet, so let's do that together. Sherwin-Williams, okay, so insider ownership, 8% there. That's pretty encouraging. It's a consensus buy. If you look at the price target, hold on, how much are they saying this to be? I don't see that yet. Of course, they have dividend. That's probably the appeal to this stock. Price target of $286. What is it now? $250. So they think it's going to go up about 13%. Forecast 5 years, 2.8 in sale, and growth of 11% year on year. Okay. I mean, if it's true, and it looks like they're doing a split ratio here of 3-to-1. Is that a reverse stock split? No, I think it's forward stock split. So they're gonna split the share April. Oh, they already did that. Okay, so net income is positive. That's good. About 10% more profit margin. Okay, if you look at the PEG ratio, it's not the end of the world there. It's actually pretty good. Earnings, current ratio is not too bad, 0.5. Not too bad, but you want it to be above 1. Remember, of course, they have more debt, 3 times debt than the shareholder equity, 2 times debt than earnings before interest and tax, 7 times debt than cash flow positive. They are good with interest coverage. It's good that they have positive working capital there. But net cash, man, net cash. So total cash minus total debt is negative. That's bad, right? I wonder what GameStop is. Okay, I know. It's two different company, you guys. Two different company. Which ratio was I looking at? I think it was working capital right here. So net cash, you see net cash positive for GameStop. But for this one, net cash negative $12 billion. Ooh. Yeah. And per share is a lot. Capital expenditures not too bad in terms, in comparison to the operate cash flow. Profit margin, obviously, we did the math already, around 10%. That's good. Tax, around 21%. Okay, that's pretty good. I mean, I've seen some company that only pay 4%, you know. I'll let you guess what it is. Okay, so this is Sherwin-Williams. Apparently they're a home builder here. So again, this is a different industry, so I can't, know much about it. I feel like I don't. Again, I'm just like looking at this, and then I'm like, okay, look at this. The fact that they have inside ownership of more than 1%, that's encouraging. So I would rate this one to be a buy more than the other one. But the concerning factor is the fact that they have negative net cash, right? They're not going to go bankrupt anytime soon, of course. But, let's take a look at it further down, shall we? So they have 10% profit margin. That's pretty good. And positive cash flow. That's good. And then what else? 14% earnings before interest and tax. That's always a good thing. So let's look at the balance sheet here and trailing 12. So they have 200 million cash on hand. That's good, but look at the debt, man. It's so high. $12 billion. But if you look at the shareholder equity, there's only $3.6 billion. And that is why when you do the cash on hand minus the debt, that's what you got here. Yes. So can they service the debt? It seems like they did try to kind of pay it down here, but then they add more. So they add about $500 million of debt and then pay off $200 million back. And it seems like there's a pattern here, right? They add on debt, and then pay a little bit back. So, if you look back, the history of this particular company, you could see that ever since they add on debt, right here, from $2 billion to $11 billion. So why are they adding on debt so much? What are they doing? And from then to see 2017 right here, are they increasing in sale or not? Why are they adding on debt? So if you look at the income statement and then go back to that year, where is it? A little bit more. So it was around here that they add that $10 billion. So did you see any substantial increase from there? $1 billion in sales. So they load on 10 billion, was able to increase 10% of that. Okay, I guess that's good, but did they actually make any money because, again, look, if you look at this one from here to here, it's like around $1 billion, right? And then if you look at the cost of doing business right here, they add $1 billion to the cost of doing business. So technically, they're not really increasing in anything, taking on debt, $10 billion just to increase in sell, but then still increase in cost of doing business. It's not a good deal, in my opinion, right? And that's why they have so much debt right now to the tune of $12 billion. And what are they doing? They're just servicing it right now. So this is the over leveraging that shouldn't happen, right? Because when you take on debt, obviously, it's harder for you to pay off that debt. Now, you might be lucky and the housing market's going to go up and people just keep going to buy up your product. But, again, we all know what's going on in today's market, and I don't know why this talking head wants you to buy into this particular company. I wouldn't, especially when you have like massive amount of debt like this. You can't refinance and be secure per se, right? Especially as a shareholder, you only have $3 billion worth of shareholding equity, right? So it's a no for me. All right, guys. So I saved the best for last right here because this is what, keep my blood boil when I look at this. And I was at work when I was looking at this and I was like, what the heck? Why are they? Of course, they're going to want you to buy this company. So bear with me here. So this is O'Reilly. I'm sure you know about the company. It sells, parts, and if you want to fix the car. So the talking head over here, his reasoning is that there's some sector it's going to be good, and especially when the car are expensive, people are more likely to buy the parts and fix the car yourself, right? Okay, sure, that's probably a good sentiment, to have you buy this company, right? All right, so I'll scroll down and kind of look into it. That's not too bad if you look at the, market cap. Of course, $57 billion. That's good. Positive beta. Of course, it's trading up 28% from its 52 weeks price. So it's highly, it's overvalued in my opinion. RSI, of course, it's indicative that it could run even further, which is fine. If you look at the inside ownership, at least it's more than 1%, but this is not enough to entice me to buy into it, right? I would like to see at least 10%. Okay, GameStop is 13%. Okay. So, but anyway, and of course the price target, these talking heads want you to buy O'Reilly, and the target price is $1,645 a share. Okay, now they have a low float. I'm not saying that justify or not, but perhaps it's because of the low float. But they could expand it, they could dilute it, they could do whatever they need to, right? So it's a buy. Of course, the price target, if you look at hold on, let me show you the diagram here. Look at this. So they want you to buy, obviously. It's a strong buy to people. Right now, it's the average was $1,600. Close to there, and look at the high. $9,000, right? So of course they're thinking, oh, the high is going to be 10x from here. Okay. All right. I mean, they might be right. They might be right. But okay, let's take a look. Who are these people? Okay. TD, I guess TD Ameritrade related. Not quite sure who that person is. Citigroup, blah, 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 right? All right. So that's fine. So let's just look at the stat right here, because what I know best. So if you scroll down, obviously, if you look into this one, anything below 10 is better, right? It's undervalue, or at least it's fair value, right? But anything above 10, that means overvalue. Okay. So if you look at the at Google, that's what it says. Price to sell, obviously, we want it to be lower than 1, but 3 is not too bad. Price to cash flow, we want it to be below 10, right? Of course, this is twice as expensive. PEG ratio, we want it to be below 1, but between 2 and 3, that's okay. If you look at the revenue, it's not pretty, I mean, it's not bad, you know, $15 billion in sale. And if you look at the net income, that comes around to be maybe 8% or so. Okay, let me do the math real quick. If you do the ratio, I do the net income divided by the revenue. That's going to give you the 15%. Okay. Okay, that's not too bad. Right? And if you look at the fact that it's positive, you know, everything is positive, kosher, great. And then you get to the nitty gritty right here. So if you look at the cash on hand, they only have $57 million right here. Total debt of $7.1 billion. If you do the cash right here, minus that, of course, they have negative $7 billion. Okay. So the net cash position for them, when you do that and subtract it with the total debt, you're going to have a negative net cash position. So what does that mean? It means that they're going to need cash eventually, right? When they run out of this $50 million, who are they going to run to? Shareholder, right? But wait. And of course, working capital, we want it to be positive because you want the day-to-day operation to be in a positive, right? Because if you read this here, working capital is the amount of money available to a business to conduct its day-to-day operation. So they don't even have enough money for that quite yet, right? Assuming that they're going to run out of this soon. As far as operating cash flow, of course, $3 billion, that's not too bad, you know, compared to this. That's probably why they're not like, you know, running out with the, you know, running out screaming for help or anything. Positive cash flows, pretty good for $2.6 billion. So I guess they have that to fall back on. But if you look at the shareholder equity right here, sorry, not shareholder equity, return on equity, it's negative. It's a negative percent, 167%. So if you buy into this company, you're bound to lose money on equity wise. And I'll show you in a minute why. Of course, they pay some tax. That's good. At least it's above 20%. If you look at the gross profit margin, of course, it's pretty good. And the profit margin of close to 15% is good. Okay. So they do have, I guess, monopoly, you could say, or just the popularity. You know, everybody knows the company. Of course, they could charge you more on that. But let's go look at what kind of like what is going on here, right? So if you do the trailing 12, obviously this is where you see the $15 billion. That's good. Gross profit, that's good. Everything that you see here, I feel like, yeah, it's pretty reasonable, right? Cash flow positive. Good. Sometime profit margin is even up. You know, if you account for earnings before interest and taxes, right? But then if you look at balance sheet, this is where I'm like, what the hell? So cash, obviously we saw that. And then you look at the shareholder equity, right? Bam. So shareholder equity is in the negative. Which company that has the shareholder equity in the negative too? Remember? AMC. So, I mean, to me, this screamed trouble, no? Right? So why are these analysts telling you to buy this company? It just makes no sense. Now, I get it. You know, you are probably a main category, you know, as that guy was saying. Some company are just main category, so they have the ability to attract customer and all that stuff. But man, with the amount of debt that they have, $7 billion, and then the fact that they have negative shareholder equity, I wouldn't touch it until this turns positive. And it seems like they've been negative for 1, 2, 3, 4, 5, 6, 7, 8 consecutive negative shareholder equity. For a long time. So what does that mean? It means that if they file for bankruptcy, shareholders not going to get anything. Now, do I think they're gonna file for bankruptcy anytime soon? No, I don't think they're gonna do that, because they could, leverage their asset, I bet. I'm assuming. Look, hold on, let me see their asset real quick. I mean, they have more debt than... They don't even look at this. Oh, because it's negative shareholder equity. That's why they did not calculate that. But I mean, all in all, my conclusion is that, any time they tell you to buy something, you better look into the balance sheets first, right? And to me, the main theme, the theme of everything that I'm like showing you here is that they have low ownership, insider ownership, right? And then they have massive amount of debt. And then the other theme is that they have negative net cash position. So now some company, obviously, that he mentioned Costco. We know that Costco is good, right? Walmart, I haven't even looked at it yet. But, they're kind of in trouble too, no? Because they've been laying off people. They've been cutting down. They were blaming it on theft and all that stuff. But why not just add more worker? If you go to Walmart lately, right? They have those self-checkout. They don't even, employ enough people to check you out even. So, I mean, no wonder there's theft. It's easier to steal, because, again, there's hardly anybody working. So, anyway, so this is O'Reilly. So I just don't see it. I don't see how this price target is something that it's it's like touting and all that stuff. And of course, again, they want you to buy their back. Okay, they have been holding this company. If you look at the inside ownership, right, 80% is institutional ownership. See, yeah. So again, be vigilant out there. Don't just believe in what you're hearing, and do your own research. especially with GameStop too. You know, GameStop has come a long way. Now we still have a whole bunch of stuff to work out here. Of course, we want the return on equity to be on the positive, and I'm sure we're gonna get to there, right? We have a great quick ratio, we have a great current ratio, we have a great debt to equity ratio. You know, we're still working on this one right here, debt to cash flow positive. We want it to be less than 1. Can we achieve that? We probably. But I mean, as far as, you know, all of this stuff, look at the cash position we have. I mean, you know, look at the working capital, close to $1 billion, meaning that we have enough, you know, money to conduct the day-to-day activity right here. Net cash, look at this, close to $500 million right there. And yet, look at this analyst. They give us $6 price target. Ridiculous, no? I mean, look at the shareholder equity for GameStop versus O'Reilly. I mean, did I show you that? So GameStop has $1.3 billion, okay, in shareholder equity versus O'Reilly, which has 10 times the market cap of GameStop. But yet they have negative shareholder equity. So, what the heck? See this? $1 billion. And if you look at the trailing 12, it's even more egregious, right? So they've been in the negative for 8 consecutive quarters right here. Right? And if you look at the debt, of course, they've been increasing that from 5 billion to 6 billion to 7 billion. So is that a private equity handbook or what? You know? So that's the whole point, is that most of these companies that they're pushing right in front of you are heavily in debt. Now, whether it's heavy or not, you know, depends on how much they make. But it's still, though, it's a burden that the company has to go through in order to generate profit for shareholders, right? And usually shareholders are the one that is getting paid off last in case of bankruptcy. So yeah, we're getting screwed every single time, and it's not a good look. It's not everything that anyway, you guys, I am getting stuffy. I have no idea why. Around this time is when I get a little stuffy nose, so I'm sorry about that. And if it's long-winded, thank you so much for joining me. I see that you guys are writing here. Eyeliner, sounds good. Fixing the book. I know, right? Do you have a Discord channel? No, I don't, Lynn. I'm sorry. I'm not a, you know, like a YouTuber or anything like that. You know, I'm just trying to learn as I go here. And as I said before, I was kind of try to share my journey with you in investing in GameStop and in discovering stuff like this, right? One of my focus is like media coverage, right? And I've seen this in politics too. Like, I don't want to get it political here, but it's like a certain candidate get covered more than a certain candidate, and it's the same way with stock. I could kind of relate to that as well. And when I see any media coverage on GameStop, it's always like very, very biased. And so that's why I just make this channel. So I don't have any Discord. I suggest Moran's. If you don't know Moran's, I bet you anything you're probably Moran's subscriber. He has a much better, you know, community in there. So yes, I hope that's answered your question, Lynn. All right, guys, that's all I have for this one, and I hope you get something out of this. But yeah, I don't know. I mean, the one company that I would buy from that list is this one. But again, it's still, look at this massively amount, $12 billion in debt, but then they only make $20 billion. And if you look at the net income, it's even less. So they make $2 billion, but yet they have $12 billion in debt. So, and in a higher rate environment, that is still a concern. But of all the Kroger, O'Reilly, and one other one, I would buy this one, right? But again, this is not a sector to be in either because it's in housing. So yeah, I would just do it like 1% of my portfolio if I want to kind of bet on this. But again, no, I'm GameStop all the way, right? One share at a time. It's ridiculous that they've been pummeling this down. But again, hey, it's more share for all of us, right? The lower they get it to, the better. I guess they want us to own more of GameStop, so that's a good thing. And I would just focus on this, like shareholder equity. Shareholder equity. We want it to be at least $2 billion, like it used to be. And with the marketable security and all that stuff, look at this. We increased by close to $50 million of treasury bonds, right, and accruing interest. So and look at the inventory. See, we were able to sell a whole bunch of inventory. I bet you anything he's gonna try to increase it next quarter, and he's not gonna post any gain. Right, and we're gonna see it on this right here. I don't know, maybe just to hide the interest and all that stuff, right? I mean, to hide the profit for the next, the fourth quarter. I bet you anything he's gonna surprise people on the fourth quarter earnings rather than the third one. Maybe he wants to keep it lower so that we could buy more. Who knows, right? Who knows? As far as retaining earnings, obviously we need to, keep that lower than what it is today. But again, like I bet you anything, this time period was because we spend money to make this company a stronger company. Whether it is the NFT marketplace, paying out immutable X and all that stuff in order to, get into the NFT space. And I know for sure he's not going to scrap that because that's the high growth margin items. It's just that they need to, in my opinion anyway, they need to wait for the regulator to jump on board. And once they know what the rules and regulation is, they could pivot and make the NFT fit for whatever the regulation is. And they're going to capture some of that market cap. So, and that's my original thesis on GameStop. That's why I got in the first place, is the fact that they went into NFT marketplace and, joined in the crypto revolution, right, so to speak. Because we know crypto is here to stay. All the big guys out there, they're just, footsying around it because, again, they were late to the game. And so the only way that they could get back in is to scare people out of the market, right? So they would send their regulator, they would send, the SEC to go after, Ripple, to go after XRP, to go after every other coins out there except Ethereum for some reason. So that's another thing too. Actually, I want shout out to Marantz too, if you want to let him. I want him to do a connect the dot with Ethereum and how, you know, the SEC chairman, former SEC chairman, were kind of like in collusion with, you know, some private equity and all that stuff. I bet you anything it's probably private equity. FTX, you know, that's like a scam, right? And just so happened that we as what is it? Sorry, my dog is distracting me. But I mean, GameStop, you know, went to a partnership with FTX, and we all know what happened there. So maybe there's some private equity influence in that. So I would be, you know, he's such an amazing researcher and digging around on those type of things. So I wouldn't do a good job on it, honestly, because I'm not that type. So, but anyway, just shout out to Morans. Keep it going with your bid, like Morans always says. Can't stop, won't stop. Of course, thank you so much. I appreciate that. But anyway, I'm gonna end it here. Was a long time for me today, and my dog is going crazy. So, all right, thank you guys for watching, and I'll see you later.